Hey everyone, Jeff McGinnis, CrossCountry Mortgage, and another Mortgage Minute presentation today. We'll be covering what's happening with rates, real estate, and recession. We got a lot to talk about, so let's get to it. I'll share my screen and we'll take a look at the current marketplace. So when we take a look at the current marketplace, inflation is a big word. We've got inflation over 8% now as measured by the Consumer Price Index. And while it may peak temporarily over the summer months, we could see it come back. And inflation is the arch enemy of mortgage rates because, think about it, the receiver of those mortgage payments typically receiving a fixed payment over a longer period of time. And inflation makes things cost more. So the money doesn't go as far as what you're receiving. It's a fixed payment, but it buys less and less. And the only way you can combat higher inflation if you're the receiver of mortgage payments is to charge a higher interest rate to offset the more rapid rate of erosion. Now, a lot of talk about the fact that we anticipate the Fed will be hiking interest rates as well. Quite a bit we expect in the coming year, but counterintuitively, it doesn't necessarily mean a bad thing for mortgage rates. When inflation slows down because the Fed hikes rates to slow economic activity, rates respond favorably and decline. But here's the other thing, the Fed balance sheet has amassed like $9 trillion between mortgage bonds and treasuries. And they've also said they would now start to allow those dollars to run off as they mature, as they collect principal payments instead of reinvesting them, which is what they've been doing, by the way, in that would allow a portion of those, or maybe all of the receipts that they have to run off their balance sheet and reduce their holdings. And that means less purchases of mortgage-backed securities. Now, another big buzzword is recession. We've been talking about this since late 21 and in our forecast for 22, where we said that late 22, early 23 looks like a recession is on the horizon. So what does that mean? What does that mean for mortgage rates and what does that mean for housing? Let's take a quick look. All right, so let's talk about the Fed and do a quick recap. Now we go all the way back to the 70s and 80s. In the late 70s, Arthur Burns was the Fed chair, and he watched inflation go from 7 to 14%. And as a result, remember we said rates has to go up when inflation goes up, and it did. It went from 12 to 18%. Paul Volcker came in, and he took our Fed funds rates already at 11% up to 20% within 2 years. And that slowed the economy enough so that inflation went way, way down. And mortgage rates, because inflation dropped, mortgage rates went down. So let's understand this. Fed funds rate way up. And then because inflation declined due to a slower economy, mortgage rates dropped. So Fed funds rates up, mortgage rates dropped. But there was a recession. And just about every time the Fed tries to slow inflation in the economy by hiking rates, we get a recession, and the stock market didn't like it. As you can see, it went down 30%. Now, under Greenspan, he also saw inflation. He took the Fed funds rate up almost 2% within a year and slowed the economy enough to where inflation dropped. And because inflation dropped, mortgage rates dropped from 8.5% to 3.5%. So think about that, hiking rates, and because he slowed the economy enough to kill inflation, mortgage rates declined. So pattern here. But again, that part of that pattern is recession, and it's almost unavoidable. And it's kind of rough on the stock market, as you can see. Today, Jerome Powell has seen inflation go up quite a bit. He's seen it go from 1.5% to 8.5%, and mortgage rates go from 2.5% to 5.5%, if not higher. And there's a possibility that you could take the Fed funds rates, which was at 0. Now he's bumped it 1/4 and another 3/4 just recently. And there are thoughts he could go somewhere near 3% by the end of 22, which should cause inflation to drop, and that means mortgage rates should drop towards the end of this year. And with the pattern we've seen, we think a recession is pretty much unavoidable, and the stock market, if you go by history, might be difficult for the stock market. All right, so let's take a look at the last time in this situation where the Fed was hiking rates, but it had a balance sheet that they started to allow to run off. So it happened at the end of 2015, December of 2015, the Fed hiked by a quarter. And then what happened here? Well, mortgage rates actually dropped. Now, as inflation started to creep back in, the mortgage rates went up, but then the Fed hiked again and mortgage rates dropped. The Fed hiked again, and then mortgage rates dropped. The Fed hiked a few more times, and then there was a talk of a runoff. And you can see when the runoff started to happen, rates started to rise. And if you look at this, it actually took, let's see, 1, 2, 3, 4, 5, 6, 7 rate hikes. And on the 8th one, the Fed took rates up about 2%. And then finally, mortgage rates started to respond as the economy slowed and really started to move down here and then cascade lower. And then when the Fed slowed their runoff because the economy was really slowing, you saw a big drop. And when they stopped the runoff of the balance sheet, well, you see a huge runoff towards the end. And so very, very constructive to learn from this, because we can see mortgage rates, while they're a little bit elevated now, there's a bright future, even though the Fed's going to be hiking rates once we get past the period of the Fed runoff. Now, you've been hearing a lot about inverting, the inversions of a yield curve. A lot of times what that means is the 10-year Treasury is yielding a lower rate than the 2-year Treasury. And that's abnormal, because the longer you tie up your money, the bigger the risk, and you should get a bigger reward. And when this happens, it's a great indicator of recessions. Now, the past year, we've seen the spread between the 10-year Treasury, and when you take that yield minus the 2-year, it stays positive, but it's getting closer, closer, and closer, until just recently it went upside down, and the 2-year was yielding higher than the 10-year. And that has a lot of people saying there could be a recession in the wings, and I tend to agree with that. And as you can see, it's a pretty reliable predictor. If you look through the 70s and the 80s and 90s, when you see that inversion, a recession follows, and we're seeing that again here in 2000, and most recently 2019 and 2020, that short recession there. So maybe we're not repeating ourselves, but it is echoing the history that we see here tends to echo. So we got to be aware of what that means when we have a recession, but there are some other indicators that we want to watch out for as well. And one very reliable one is the unemployment rate. When the unemployment rate reaches its lowest level and starts to rise, it becomes a great indicator that we're going to have a recession. And you can look back to the 40s. Lowest level starts to rise, recession. Look again, every time with about 100% accuracy. And the most recent one, here's where we are today. If you look, perhaps we're not at the lowest yet, but once we're seeing Fed hiking rates and trying to slow things down, and if we see that unemployment rate start to tick up, you can see it's a really reliable forecast for a recession. So what does that mean when you have a recession? Is that a bad thing if we get one, like we're thinking by the end of this year or early next year? Well, as far as mortgage rates are concerned, we've seen drops in mortgage rates at every single recession, and by quite a bit, I might add. You see mortgage rates drop. So, okay, so recessions have to be bad for real estate, right? Well, not exactly. So as we look at real estate historically, you can see that in the 60s, 70s, 80s, 90s, every time we had a recession, prices actually did, actually pretty well. So, and it went up quite a bit afterwards. So even in the early 2000s, but we had one anomaly here, right? The housing bubble. And that happens when you have zero down, fog up a mirror loans where you're doing no income, no asset, no job, and poor credit scores. You're still getting a mortgage on multiple homes. Well, the housing bubble was overcooked, and that had to pop, and that actually led us into the recession. And it wasn't the recession that caused home prices to decline. And you can see after finding our footing, you can see prices have gone up quite a bit since then, and have actually, since the last recession, true to form of the previous ones, other than this one time, so 8 and 9 recession home values going up and continuing higher. We believe that the housing market today is much stronger because look, in 2007, there was a lot of inventory, 3.7 million units for sale, and today is much less than 1 million units for sale, so a lot less inventory. But meanwhile, households have since then have grown. So you can see households are much greater than they were back in 2007. So we've got 14 million more households fighting for 3 million fewer homes. We think that while we have a period of time here to contend with, the future looks very bright.